Now, as we pivot over to the U.S. economic data, we had some interesting data points that we want to look at. Initial jobless claims continue to come in below estimates. Again, the jobs market is not indicating any real problems. All the more reason why, when you look at it from a hawkish standpoint, and we're going to talk about hawkish. And hawkish is someone that wants rates higher for longer. Dovish is someone that wants rates lower to be more accommodative on the liquidity side. So those are the two differences. If you haven't figured out, I'm more on the hawkish camp, but again, those are different pieces. So when we look in the U.S., GDP annualized quarter over quarter, expectations for 1.9 came in at 1.1. The prior was 2.6. So you see some of that, again, that deceleration. Personal consumption was expected at 4%, came in at 3.7. So slightly below estimates, but again, you can see it against prior was much better. Prior was 1%. So when you look at some of those flows, but when you look at Q1, that's normally what happens. You normally kind of get a bit of that pop because you have deals, you have people are buying in January, you have some additional purchases in March as people start to gear up for spring. So typically you normally get a little bit of that increase, but you can see that against estimates, it was a miss. GDP price index, which is a pivotal piece of what the Fed looks at for the pace of inflation, for where things are going. You can see GDP price index was expected at 3.7%, came in at 4%, and actually was higher than last quarter. So you actually saw a little bit of a reacceleration. And the bigger fear on that, on the core side, it was expected at 4.7, came in at 4.9, and you saw that bounce up well above what was last quarter at 4.4%. So when you look at the inflation front, you're seeing a lot of those fears, a lot of that pushing back up, and some of those pressure points, which we don't think are slowing. And again, that's where we continue when you go through Q1 and now you're in Q2, because remember, this also picks up March. March was a good period for gasoline, diesel, oil pricing. And now as we get into April, that has pivoted hard. So you're starting at a fairly tough spot, which again is part of the reason why we remain concerned. Pending home sales had a big drop, but again, there's some of that offset as well, which we'll talk about more of that in Q2 in segment 3. And then Kansas City Fed came in a bit light, but we'll talk more about that in the next segment. So real GDP came in at 1.1% quarter over quarter, 1.6% year on year. A lot of that was a massive inventory drag, and we have to account for that, because when we had a big beat on GDP, a lot of that was covered by inventory, and now we had a miss, and a lot of that was covered by inventory, and you're getting these big swings as we get some of this destocking. So consumer spending was strong, but again, the momentum is weakening, and we're going to talk more about why it's weakening or how we're seeing it weaken in the next segment. But real GDP versus pre-COVID trend is negative 1.9%. So you're seeing that what we've been talking about of that fiscal drag. So you had a huge surge of just money coming in. You had everybody spending as fast as they can. And now you have that slowdown. And that's some of that drag that we've been talking about. So then when you look at some of the different pieces, obviously consumer spending, as we've been saying, is paramount for U.S. GDP. Consumer is king, but that's where credit cards come in. That's where services come in. And that's why when you look at the stickiness in all of those different pieces, that's when you're starting to see some of the bigger impacts. Then you look at federal spending can remain very strong as you look at it over this period. 7.8%. Net exports and goods was slightly better, but again, it's just we normally kind of bounce around here. Fixed investment slowed down. All of that being on the residential front. We don't see that adjusting so much on the residential side. We do see a bigger slowdown on the non-residential side. So fixed investment is going to draw some of that down, but you can see the change in private inventories, and you can see how lumpy they've been for the last couple of months, last couple of quarters, and a lot of that is driven based on the delays that we saw with COVID, then the delays that we saw with different levels, then people restocking, and then people slowing. So now You saw private inventories come down, but we're going to look at wholesale inventories, which have actually started to creep up. And those are some different things that we continue to look at in terms of pressure points. So again, here's some of that deceleration that we've been talking about: 3.2%, 2.6%, 1.1%. And now it's a matter of kind of where we go. And here you can see consumer spending still kind of driving the show here. Inventories, when you look at the GDP side, looking at GDP, you get an idea of kind of where things sit. Things would have come in pretty close to what expectations were. When you look at government spending, when you look at some of these different flows, government spending we do see waning a bit more, especially as we come towards an issue with the federal deficit and the debt ceiling. But inventories was that piece. One of the things that we keep talking about is consumer spending. We talked about it in segment 1. It's really hard to nail down. It is what it is. The consumer is more resilient than at all times, and then they're much weaker than people expected. And you never know, again, where you're going to cross that line. And our view is that we're getting close, but again, it's hard to nail that down. So, or realistically, we think it's already started, and it's only going to escalate as we saw retail sales go negative last month. We think that based on inventory data, which we're going to talk about in a minute, inventories are starting to build at the wholesale level, at the retail level, and that just is showing you that you're getting some of that pressure on the consumption side. But there's enough for everyone. Hawks, again, will point to the rebound in average private sector demand growth, sticky core inflation, again, everything I've talked about. And the doves will point to weak momentum for demand and slowing inflation. But again, slowing inflation year on year is different than, because we don't see a slowing inflation month over month. The rate of change may be slowing, but it's still positive. And that's, I think, the bigger overhang. Final sales ex inventory up 3.4%. Final sales to domestic purchasers up 3.2%. Final sales to private domestic purchasers up 2.9%. But again, just descending. When you look at it against chained, annualized at 1.1%, slowest growth since second quarter of 2022, which was a negative quarter. And then when you look at it in terms of the GDP price index, it reaccelerated. And those are some of the pieces where, and you can see it obviously had a massive, it's coming down from these highs, but you're watching it flatline. You're watching it level out. And when you look back through time, 4% is still the highest it's been going back to the 1980s. So we're, even with this deceleration, you're still at extensive heights in terms of where we should be. And that's, again, more of that pressure that is being mounted on the consumer, which is causing some of those slowdowns. But while all this is happening, the U.S. CDS continues to get worse, which just is a panic or the likelihood of a U.S. government default. But then you look at the bonds. Bonds are telling you that risk is still an issue. Volatility is still real in the bond market. And if you look at it, the equity market's asleep. And you're like, all right, well, now, again, I think the fear is always overblown. When you look at the U.S. Debt ceiling, it'll always get moved higher. It's just political masquerading ball that they love to play. But the biggest issue is between the VIX and the MOVE index, and I think typically the bonds are the leader. It's a market that dwarfs the size of the equity markets, but again, there's some of that disconnect, which is why I do think there is more risk on the equity front. When you look at the spread between the 3-month and the 10-year U.S. yields, they fell yesterday and has continued to undercut recent early mid-April lows, which is just showing you, again, more pressure, more problems. Through March, the M2 money supply was down 4.1% year on year, which was worse than going back to 1960s. But you have to think about how is it being classified. Because, yeah, you're seeing some money supply move, but it's going into money markets. It's going into things that would be categorized as M3 and moving away from the M2 side. So it's tough to say that given the liquidity's coming down, I think that is absolutely the case. The question is the rate at which we're down. Because the whole thing is, and again, after you surge this much, so when you look at this gigantic surge from 5% to 27%, you have to take some of that out. So people are looking at this and panicking and saying, oh, look how terrible this is. It's like, well, but look at how much came into the market. Go back through the 60s and look at how much money supply has increased over that time period. Like eventually you have to balance this. And there are people out there that are like, oh, people want spending to increase, but yet they're putting rates higher. It's like, but we have to put rates higher. Like that's what has to happen. We have to increase rates to get some of this this more into point. When you look at the M2 money supply contracted by 1.2% month on month in March, worst on record. And again, but yes, it's the worst on record, but we also put the most into the system on record by a factor of over 6. Like when you look at it in general, it's massive. And that's a huge problem when you start looking at, okay, well, yes, this is coming down, but look at how much has come into the market. So again, you have to kind of balance this in terms of where it is and what has it led to. It's led to asset prices surging. And just again, I always come back to this chart because it puts into perspective the problem where you're having asset prices, by measured here as home prices, flatlining. We think it comes down, we see it's starting, but nothing happens quickly. It all takes time. And you're seeing home prices remain sticky up there. So look at that disconnect between wages and home prices. So you need to collapse that somehow. And wages, you can start to see the rate of change is starting to slow. We talked about that last week, the week before. And that's going to be the biggest problem, is bringing asset prices back in line. And then when you look at the labor market, the ratio of NFIB hiring intentions continue to slow. ECI private sector wage X incentives are slowing. So when you look at wage gains are coming down. But so clearly that red line is flatlining to rolling over. So asset prices, if they don't come down, well, the affordability of it, given the fact that mortgage rates are at 6.5, 7%, somewhere between that 6 to 7% ratio, it is becoming a problem. And again, that's where you're starting to see some of this pressure. And as wages come down, it's going to act as an anchor pulling that lower. Now, when you start looking at commercial real estate bonds and the lender types, and you look at the maturity wall, in 2023, there's a significant amount, and it only gets worse from that point. So as we go forward, this is one of the reasons why when we look at what's happening in the small regional banks, it's not going to end soon. There's more to come. Can you roll it at? What rate can you roll it at? And does the asset carry the same value that it did when this bond was initially created? And if you roll it, can you roll it at the same valuation, or are you going to take a value cut? And then what does that do to other things that you've levered? Because then you start looking at your portfolio, and is that going to cause a mark to market on your other assets that's going to bring down your total valuation of your portfolio, which then could trigger some covenants, some other problems in terms of valuation, which is going to be an interesting one to watch. M2 is contracted, but again, money is not tight. And that's when you start looking at the different pieces. So yes, when you look at the US, when you look at where things are, but then you look at real M2 and then M2 divided by GDP, and just looking at it in differing factors, because you get the shock of like, oh my God, we're negative. But it's like, okay, but let's look at this objectively and different metrics, because you had so much liquidity come in. Are we really that tight? And again, one of the things that we've been saying is no. Just because you're negative right now, they put so much money into the market during COVID that there's still ways to go just to even get back to the trend. So then when you start looking at some of the different shifts and the way things are changing, again, looking at liquidity, which is tightening, which means that money isn't going to be as easy to get. It's not going to be as free. Well, then let's look at the commercial real estate market. So when you look at some of the working remotely, Some employees are remote has come down. You've actually seen all employees remote slightly up, but that it's just a matter of what that hybrid schedule looks like. Share of private sector establishments with some or all employees working remotely is about 27%. And for those that have been following us, one of our views when we had that huge surge to, I think we peaked out at between 47 and 53%. Our view is like, look, this is an extreme, but we're going to settle between 25 and 30%. And that's just, where that sits, I have no idea. Is it 24% maybe? Is it 31% maybe? But it's like, it's going to settle in this because, and just because of flexible schedules. The flexible schedule is going to make it easier to work remotely, and people like it. They like not coming in on a Monday or a Friday or having some flexibility, which before it was looked down upon, but now is becoming a bit more accepted. And that's going to have a consistent change in where things are. Share of wage and salary workers in different working arrangements. And this is what we've been talking about, is like our view is that fully remote was going to diminish. And it's only because it's not so much that full on-site was going to increase, it's that fully remote was going to fall into a hybrid schedule. And so when you look at the breakdown of the differences, depending on how you break it down, about 40% is going to sit at these levels. And I think that you could get some additional people coming back, not allowing that, but you're seeing a marketed shift in the way business is done, and it'll get reduced in terms of more fully on site, but it's not going to go away. And I think that's a very important piece when we look at some of these different shifts on the way consumption happens. April Conference Board Index came in at 101.3 versus the estimate of 104. Present situation was came in at 151 versus 148, but expectations dropped significantly, which is important when you start looking at, people are like, okay, well, I'm looking around, it's like, it's okay right now, but there's all of these things on the horizon. And that's why when you look over the next 6 months on how people are going to spend, everyone's like, I'm comfortable now, but I'm really concerned about what's going to happen. And that pulls people back, and that causes less spending to happen, especially. And now you might say, well, you could have said that in 2022, but yet people spent. And it's like 100% true, but our view is that people still had the ability, given savings and credit cards. Now, when you look at it, that savings that was used during that period has been worked through, and credit card rates are over 24% after being something closer between 14 and 16% during that period. So again, that changes the dynamic significantly, which is why when you start looking at consumer confidence index, present employment is the main driver. So everyone's looking at the employment numbers, and we agree. We're like, well, you're not getting fired. Like, who are you going to hire? Like, and for anybody out there who's watching this that has tried to hire someone, the difficulty in doing it. So, but everything else is getting worse, and eventually you'll start to see some of that employment come down, which is why you can see a fairly sizable correction there. Conference Board versus GDP. This is why when you start looking at those leading the leading indicators, so leading economic index now contracting at negative 7.8% annual rate, while GDP growth as of 4Q of 2022 was at 0.9%. But it doesn't mean it collapses. And that's one of the things, like we talked about this chart last week in the insights, is where you're not going to collapse, but it's showing you the trend, and the trend is down. And the leading index has never declined this much in 6 months without a recession. And when you look at what's driving it, so work week is what it is, but new orders, expectations, interest rate spreads, all of these key pieces that really drive the economy on these basic levels is diminishing, and that's where we continue to see. But remember, consumer expectations. So at this moment, everyone's like, I'm concerned about tomorrow, but I'll spend today. And eventually that merges and people stop spending. And that's why we've talked about the difficulty in trying to nail that down. U.S. retail inventory is expected to be at 0.2, came in at 0.7. And now when you adjust that for inflation, you can see that U.S. real retail inventories are now above where they were in 2019, just showing more slowdowns, more pain ahead in terms of spending. That's no different in the March wholesale inventories, coming in at 0.1% month on month versus the estimate. Retail inventories, on the other hand, came in at a positive 0.7 versus the estimate of 0.2. March cap good orders coming down a bit. So again, you're getting less orders, more inventory, more concern for the consumer. So you're kind of getting an idea of where this is going as we see more small businesses having difficulty getting loans, bankruptcies starting to increase. And again, as bankruptcies start to increase, that's when you get more employment there. As people can't get CapEx, in terms of borrowing, they cut CapEx, they cut hiring. Those people then sit on unemployment. That's when you start to see those numbers go up. And again, you can see kind of that interconnectedness as we look at deposits at small and large domestically chartered commercial banks. Even though they've bounced, they're still not back to where they were. And you're seeing some of those concerns, and foreign related institutions are doing something similar. They're reshoring some of this money, buying some gold, using the Fed swap lines to bring some of that cash home, and really starting to hunker down. We saw it with some Italian banks starting to mobilize in order to bring back some money to shore some of the things up. And again, that's something that is not conducive for exponential growth. It's, you're going to see that contraction in terms of lending, which is why when you start looking at the different numbers in terms of some of these underlying problems, you're seeing more and more fear, more pressure. And again, nothing dies in a straight line. You get a little bit of a bounce, but you're continuing to see some of these pressure points. So that's what we have for you here. On the next segment, we're going to go deeper into some of the leading components to it. Where are we going to be in Q2? Why do we see some of these additional slowdowns? And those are some, I think, key pieces that we really want to look at when we're talking about what Q2 and beyond will look like for 2023.